You're watching MPTV. On today's panel, we're discussing fixing your home interest rate. Joining me from Mortgage Choice, David Coates, from the REIV, Robert LaRocca, and from Empower Wealth, Ben Kingsley. It's been in the media, gentlemen. A lot of people are talking about it. Should people be considering locking in their interest rate?
Look, it really is a bet that you take. You know, the bank has got a view. They've probably got more information than you do. And you're taking a punt, on what's going to happen in the future. And you see this through the money markets. The leading indicator is the banks changing their fixed mortgage rates. You can get a clue from that, I think, but really you're taking a punt. I think homeowners are best to look at their own personal circumstances, because one of the factors there is it does give you some control around your budget. That's a high premium. The good thing right now is that the risks are low. I mean, people that fix their rates at the top of the cycle, when they're much higher, they're playing a much greater risk because they're more likely to go down. Now they're more likely to go up. So the risks, of getting the wrong decision are pretty low right now.
Some people say never ever fix. Are you one of those, Ben?
Oh, look, I think from my point of view and looking at our clients over the years, the majority of the people who have fixed, if they fix for greater than 3 years, have usually said, I wish I hadn't have fixed for a longer period. So 3 years seems to be about the level that the majority of our clients will take that bet or hedge that bet, so to speak. I mean, what you're seeing right now is around a 50 basis points difference between the variable rates and the 3-year fixed rates around the market. So around 550 basis points for fixed around the 3 year versus around 6% for variable. So naturally, a lot of people are saying, I can make this 50% saving or 50 basis point saving. So they're thinking, I'll get in now. Now, we know that obviously interest rates are being reviewed every Tuesday, first Tuesday of every month. So I think you're getting a situation where people are probably getting a bit ahead of themselves. So it comes back to the family budget conversation, doesn't it, around do I need to fix? Is there a need for me to have this retainer versus trying to pick the market, so to speak?
Is it an indicator, David, of where the banks think it's going? If they're offering these rates, do they think the variable rates are coming down even further? Have got further to go?
Well, it's a good question about where the banks think the rates are going to go. There's a lot of discussion that variable rates will continue to come down, but in recent weeks we have seen fixed rates come down. As Ben said, quite a few options there, around about 5.5% at the moment. And because they're lower than the available variable rates to a lot of people are taking the opportunity, whereas over more recent years you quite often find fixed rates higher than the variable rates on offer at the time, and that actually puts people off going on a fixed rate and taking that bet about some in the next few years. But now when the fixed rates are lower, people are jumping on that opportunity, and Mortgage Choice has found recently that about 20% of people actually jumping on board with the fixed rates.
What about products that offer the chance to split your home loan and do a bit of both, 50 cents each way?
Look, and I think that's probably where you're speaking to a broker who can source the market and check what's available. You've got lots of different lending options. And I think it's then looking at the circumstances and say, well, look, if you want to put a portion, say 50% into a fixed period, and you still have your variable, because there's a few things we need to understand about fixed products. Firstly, there's still an economic cost to get out of that loan if the bank sees that they are losing money. So we know that the federal government changed exit fees, which allowed basically people to switch lenders, but not on fixed rates. I mean, there's still potentially an economic cost to the bank. So as Robert was saying, banks don't lose. So for those people who did fix at that sort of 8% range and rates come back down to 7%, there was extraordinary fixed costs to get out of those particular products. So I think hedging your bets is a good idea, especially if you're looking to get into the fixed type of product. And the one last thing about the fixed rate, with a lot of lenders, they have a limit of how much you can pay down on that loan. So if you're thinking, I'm getting a great deal and I'm making some savings, and all of a sudden you make these extra repayments, you could hit that limit. And once you hit that limit, you actually get penalties to pay extra. So having that variable portion that you can also pay into, maybe with an offset account, could be a good option, Des. And
where do you see interest rates going then? Do you see them heading south of 5.5%?
Look, I definitely see rates coming down. I think the economic indicators are there both on a domestic and also an international perspective. So I'm a bit bullish. Not as bullish as some. People are talking about a 1% cut in rates. I'm actually seeing more like 50 basis points from the current position that we're in over the sort of short to medium term.
It's an interesting thing. I think a lot of homeowners, of course, welcome cuts in rates. Your mortgage costs go down, that's a good thing. But I think we also have to have a wider view of these issues, because why does the Reserve Bank cut interest rates? because they've got a problem with the economy they're trying to deal with, that flows through to the property market and property values in the entire economy. I think for the property market, the best thing is stable, long-term, medium-level interest rates, because that is an indication the economy is going reasonably well, and that actually feeds through to the market. So I think it can be short-sighted just to hope for another rate cut, because that's actually not the best thing for our society's wealth, really.
And on those split options as well, as Ben said there, it does give you a bit more flexibility, because a lot of people do want to pay extra on their home loan and pay it off more rapidly than the actual loan term. But by splitting your loan, one of the other options you get on the variable portion is the ability usually to redraw as well. So you can put as much money as you can afford into that variable rate portion of your loan, knowing that if you need money in an emergency for some reason, then you can redraw some of that money. So not only are fixed rate loans fairly inflexible in how much extra you can pay, but they rarely have the ability to redraw if you have paid extra.
It's interesting that the banks are encouraging or going after these fixed interest rates. Then we read in the paper recently that people are paying down their mortgages quicker. People are actually, and I guess that's where the bank is suddenly seeing some profit margin eroded, I suppose, because people aren't taking as long.
What we've got to understand is there's two different areas in which banks source money. You've got basically bank bills and longer term portions of where money's sourced, and you've also got cash rate, which is basically more fluid. So if the banks are seeing the appropriate margins on the money that they're lending, they'll adjust those rates down. So what we're basically seeing is longer term money becoming cheaper. By that longer term money becoming cheaper, the banks go off and buy huge amounts of that, let's call it $500 million worth, at a parcelled rate, and then they look at that and say, what can we take that to market and what can we sell that money for? And that's when you get those determinations of fixed rates coming down. So that's a bit of a technical response, but that's basically what's happening. So the banks aren't necessarily chasing that. They're actually saying our margins are still comfortable around that level, but we certainly would like to lock in clients for a longer period of time if we can.
I mean, their overall pie is getting smaller, though. I mean, for the last 2 years in Victoria, we've seen more mortgages discharged than we have actually seen taken out. Whereas in the previous 10 years, it had been always more mortgages being taken out than discharged. So, the overall number of mortgages in Victoria, at least, has been shrinking. It's part of that, saving, not spending, and conservative consumers.
Do you know if people are still burning their mortgage papers like on happy days?
I don't know, but I think that'd be fun. It'd be good to celebrate that moment, really. It was a long time, 30 years.
Thanks, gentlemen, for that. Make sure you do your research before you look at locking in your interest rates.
This show is brought to you by the Real Estate Institute of Victoria and realestateview.com.au.